conversation today about accelerating impact capital flows to SMEs in Africa. My name is Laurie Spengler. I will be your moderator today. I'm the CEO of Courageous Capital Advisors, a member of the UK Impact Investing Institute, which serves as the UK National Advisory Board, and on the board of CDC. I'm very excited that all of you have joined us for this important conversation. Accelerating capital flows to SMEs in Africa is a relevant topic before COVID, and it's even more urgent and relevant as we navigate through COVID and think about how we're going to recover and rebuild our local economies wherever we happen to be sitting, all geographies. We hear it everywhere, we see it, we know it. SMEs are a critical building block in each of our local economies. We also hear, see, and know it that they suffer capital constraints. Today's conversation will focus on Africa, and it will focus on capital flows. We appreciate that SMEs, like all enterprises, can benefit from other forms of support, but we are going to focus our conversation on capital. So why do we hear this consistent refrain that SMEs are a critical building block of local economies? Well, basically, it's because they make a material contribution. Whether you look at it through the lens of employment, some statistics suggest that 2/3 of jobs in low-income countries are generated by SMEs. Whether you look at it through the lens of growth and tax revenues, through consumer choice and products and services, through robust supply chains, innovation. But we also are familiar with the significant capital constraint. And if we thought it was a big capital gap before COVID, it's certainly even bigger coming out of COVID. Pre-COVID, IFC suggested that in Africa alone, the capital gap was 330 billion. I dare say that's a gross underestimation, and we'll hear from our panelists about that. So despite the relevance of the topic, it's still a challenge to have a conversation or a coherent conversation about SMEs anywhere in the world. And there are two primary reasons. One is that the label itself covers a very broad range of enterprises and market segments, particularly if you add the M, another M, micro, small, medium-sized enterprises, which many of us do. It's just an enormous group of enterprises. So how do you have a coherent conversation, and how do you come up with the right financial tools given the diversity of that market segment? And the second challenge is that given the enormity of the capital gap, how do you even get your arms around it to make a difference? Well, the good news for today's conversation is we have three practitioners who are going to cut through those challenges and help us have a coherent conversation. We've set for ourselves three goals for our session. One is to provide clarity about our areas of focus and the tools we're using in response to that focus. Secondly, to share examples in action, what's really happening on the ground. And third, to propose opportunities where we can dial up that activity, individually and in partnership. So let's jump in and let's get started. As I mentioned, we have three terrific panelists. They're all doers. They're all practitioners. They're in the market every day in Africa, working with SMEs. We have Nick O'Donohoe, who is the CEO of CDC, the UK's development finance institution. We have Anne-Marie Chidzero, who's the Chief Investment Officer of FSD Africa Investments, which is a donor-backed market builder with a mandate to transform financial markets across sub-Saharan Africa. And we have Shameran Abed, Senior Director of Microfinance and Ultra-Poor Graduation at BRAC, which is the largest development organization in the world, based in Bangladesh, now operating in 5 countries in Africa and more on the horizon. Their bios are in the program, so we really want to jump into the conversation. I'm going to begin with what I'm calling a level setting question to each of our panelists, and I'm going to start with Shameran, just to articulate, where do you focus within this broad topic of SMEs or MSMEs in Africa? What are your segments of prioritization, the tools and instruments, what you do and what you don't do? And I'm going to start with Shameran, go to Anne-Marie, and then Nick with that same just level setting question, so then we have a familiarity when we go further and deeper where we're all coming from. So Shameran, over to you.
Yeah, thanks very much, Laurie. I hope you can all hear me.
Yes.
So thank you very much for inviting me. We're actually in 6 countries in Africa. We do financial inclusion work in 5 of them. We are also in South Sudan where we do development activities, but we don't have a financial portfolio. So, when we look at segments, obviously being a development organization, we have our segments. We start obviously with the ultra poor. We have a graduation program that many of you would have heard about. That has a financial inclusion element in there. So there is a part of that program which is loans and savings and even insurance. Then of course a big part of what we do is your traditional microfinance. That is a large segment. There's a lot of need still. We continue to grow our work in Africa. We intend to go into more countries, but we've got microfinance activities now in 5 countries, 2 in West Africa and 3 in East Africa. But also, after many years of working in the microfinance space, about 20 years ago, when in Bangladesh, what we found was that there was a big missing middle, you could say, between bank SME lending and sort of MFI microfinance lending. And we ventured into this new segment, which we call the small enterprise segment, which is sort of S, but a very low end of S. And when we moved to working in Africa, in sub-Saharan Africa, we found the same missing segment between where microfinance and institutions were playing and where banks came in with their SME segment. So for the purpose of today's conversation, I think I would focus very much on that small enterprise segment, and also talk about our microfinance segment. As you said, it is an MSME segment, and the need is across both.
Super helpful. Thank you, Shameran, and really teasing out, as you say, what you discover are gaps, continuing gaps in the kind of financing opportunity, especially when we think largely about microfinance and then SMEs that are bankable by regulated financial institutions. So that S, as you've described it, really helpful to have that pop. Anne-Marie, same question to you.
Great. Thank you very much for inviting me to this panel. It really is a delight to be able to share with you what we're doing at FSD Africa Investments. So just for clarity, FSD Africa Investments is the investment arm of FSD Africa, which is funded by the UK government. And its mandate is to strengthen financial markets to alleviate poverty. FSD Africa does that through a number of ways, through technical assistance, collaboration, convening, capacity building, etc., using mainly grant funding as an instrument, but working with both public and the private sector to create the enabling environment for innovation and change in the market. We intervene as FSD Africa Investment to provide the early stage risk-bearing capital to selected and potentially breakthrough firms that we think can, one, strengthen the market, but more importantly, address a gap in the market. So while we use this capital to change the risk return profile, because we have a very high risk appetite, and so we can come in and crowd in other sources of capital to in a way change that risk return profile. We are seeking to provide early stage capital to what we would call alternative types of intermediaries. So we're not going to invest in the SMEs directly per se, but we want to invest in the intermediaries that we think can better serve these SMEs. And just to give you an example, working capital, and particularly now under COVID-19, is a big issue for these SMEs. And so we're looking at a number of transactions to increase the use of receivable finance, so supply chain finance, as a way to allow these SMEs to turn over cash faster and to be able to address the constraints that they're seeking. I can go in more detail later on at some of the things that we're actually doing for COVID-19, but just to really demonstrate that we are wanting to put capital into the market. We have very high risk appetite. We want to support innovators that can fill the gap, but also crowd in other sources of capital.
Terrific. Thanks, Anne-Marie. And good clarification that you're focusing on your direct investments into the intermediaries that then serve the SMEs. To what extent do you look through to the S and the M that those intermediaries are serving, or is it really how is that factored into your thinking and your prioritization?
So we are particularly focused on the micro and SME, so the micro, the traders, particularly now under COVID-19, but generally speaking, we're concerned about the micro traders, but also the small to medium, so the early stage small businesses that just don't have access to
Right.
neither equity or debt capital or working capital. So it's really the micro and the S of the SME. Yeah.
Terrific. And you added a nice dimension here. So it's both the size of the organization, but it's the maturity and then that type of capital that they need that for the earlier stage. So thank you. Very helpful. Nick, how about you? Where would you articulate CDC's positioning within the SME universe in terms of priorities, segments, areas of focus?
So good morning, Laurie. Good morning, everybody. It's nice to be here. So CDC, of course, is a development finance institution. We're the UK's development finance institution. We were actually the first development finance institution in the world when we opened 73 years ago. And so we like to think of ourselves as the world's first real impact investment firm. We've been doing investing in support of sort of private sector growth and job creation and development ever since then, and particularly in Africa. We invest about $2 billion a year. Of that 2 billion, it goes to two regions. One is Africa, principally sub-Saharan Africa, and the other one Asia. So of the 2 billion, last year, about 1.4 billion went to Africa. So we're a very large investor. And I make that point because obviously that dictates to some extent the way that we can interact with SMEs. Our minimum investment size when we're investing directly is pretty substantial, so $25 million and above. So that really takes you out of the range of direct investing in SMEs. So in order to reach that SME population, and it's obviously critical to reach them, given the critical role, the crucial role they play in employment, particularly in the countries that we're active in, we have to use intermediation. So and we intermediate through two channels. Firstly, we intermediate loans and debt products effectively through banks, and those are sometimes international banks. Usually, when we're talking about SMEs, some of the local banks. Usually, that finance, that intermediation, we try to be directed. So we try to direct it into specific areas, so, such as trade finance, for example, where there's a higher likelihood of reaching SMEs. So that's one way we do it. The other way we do it is through private equity. The way we intermediate equity is through private equity funds. And there, we are the largest, CDC is the largest limited partner in African private equity funds. So that's how we do it. Now, I think in terms of, what results we've had. I mean, I think, and Anne-Marie made this point, but I think it has been for development finance institutions challenging to reach the DFI segment, and it's been challenging principally because of weaknesses in intermediation, which is the point that Anne-Marie was focusing on. And intermediation by banks is weak because, as we know, in many of these countries, they're running very large government deficits, they have very weak currencies, they have very high interest rates. There's a strong incentive for financial institutions in those countries simply to take money and give it to the government and earn a spread. And the real economy, and particularly the smaller end of the real economy, gets left out. And then on the other hand, in the private equity fund model has not been a particularly successful model in Africa, and particularly now, those funds are really struggling to raise capital, and without some form of equity, private equity, then that leaves a sort of a huge gap in overall financing. So that's, I think, and the way that we're trying to address that is, as I said, through more direct, when we use banks, try to be more directed about the way we, don't just put the money on the balance sheet, but really be very directive and prescriptive in terms of the type of companies we want to reach, and particularly the type of outcomes, development outcomes we're trying to achieve. And then also, as Anne-Marie mentioned earlier, try to help as much as we can develop alternative sources of intermediation. And India is obviously another big investment area for CDC. see. And I think there's some good learnings from India here in terms of their development of the sort of non-bank financial companies in terms of small finance banks. They've done a much, I think there's a much broader, richer, deeper intermediation layer between large sources of capital like DFIs and companies, but particularly SMEs.
Thank you, Nick. It's super. So what we've heard from all three of you is that yes, this is a priority area of focus. You span, I would say, the full range of enterprises we alluded to in that term of micro, small, medium-sized enterprises. It's not an either or, it's not a right or wrong. All of them need additional capital. But I think this notion of how do you reach them? What are the efficient means to reach them? You have BRAC as a direct operator, and then both with FSD Africa Investments and with CDC looking for channels of intermediation to reach more of the SMEs at scale. And I think that's really what we want to get to in the core of the examples you're going to share. But as a prelude to that, given the significance of COVID and the impact it is having on the ground, Emery, I'm going to ask you to share with us, what are you seeing with respect to the SME sector generally? Are there particular pain points that you are seeing that have been exacerbated by COVID? Is it too early to tell? Are there any patterns that you're beginning to see that are factoring into your work and the responses that you're bringing to market?
Thank you. I think the impact is going to have a longer term period to actually materialize. I think the immediate impact, yes, businesses were closed and people may not have been working, particularly the traders, and so we sort of come out of that because the lockdowns have been lifted. But I think the impact is going to be felt longer term. So what we're seeing is a number of businesses that are just not able to meet their expenses, having to lay off people. Other businesses just who were in capital raise, not able to raise the capital, liquidity constraints. We're also seeing financial intermediaries themselves, particularly the ones that are focused on this market. And I'll talk about the microfinance institutions who are seeing a deterioration in their portfolios and the quality of their portfolios. Which again is an illustration of the stress that these businesses are facing. And so there is certainly concern about, we talk about alternative financial institutions, but there's also concern about those institutions that we have invested over 2 decades to build, and can they withstand this crisis? Again, we're, I think, at the beginning of it. It's hit us. There will be a longer term ramification of all of this. And we are actually trying to be ahead of the curve to look at now the immediate needs, but also just on a longer term basis, how do you make sure that you're still supporting alternative providers, but also supporting the existing institutions that are serving this market?
I think that's a great point, Emery. Thank you for that. I think sometimes when we're looking for new solutions, we tend to look for the new pathways and sometimes creating new, when in fact we really do need to be doubling down on the existing players, which is a good segue to Shameran, BRAC being an existing player. So Shameran, what are you seeing on the ground? What particular pain points have been exacerbated by COVID from your perspective?
Yeah, so if I could just give you just go back a few years and talk about quickly our experience during Ebola. So,
Sure.
it was, I shouldn't say similar, but some comparable kind of situation in West Africa when we had the Ebola crisis. And we have, microfinance operations, including this small enterprise segment in West Africa as well, in Liberia and Sierra Leone. And at that time, once the countries sort of got over the health challenge and started opening up, I think the first mistake we made was to think that we would start collecting and then slowly start dispersing. And one of the main lessons we learned in post-Ebola recovery was actually, as soon as people are able to get back into business, they want to get back on their feet and they need money. And we quickly realized that we needed to start dispersing very quickly. So this time we kind of that was on our mind. So, even during the period of lockdown, obviously we couldn't operate for a number of months, and it was different in different countries. Certain countries like Tanzania, where we operate, never really even went into lockdown. Rwanda went into a really good lockdown and then came out early, and then Uganda went into a lockdown and came out quite late. But we kind of, in each of our countries, we tried to make sure that as soon as the lockdown ends and we're back out, we can go out and start disbursing aggressively. Because again, the pain point we see is at that point, people need money. And the one thing they can't find at that point is people willing to lend to them. So whether I'm talking about my micro clients or my small enterprise clients, obviously in normal time, there is a big credit gap, but at a time like this, it just exacerbates that. And the recovery becomes slower because they can't find access to, they don't have access to funding at that time. So from BRAC's point of view, obviously, Africa is a massive continent, and we're only in a few countries, and we serve a certain number of clients, but we're trying to make sure, at least from our point of view, that we get ahead of this and start disbursing as quickly as possible. Because in our view, the main pain point is at this point, people will need to get back on their feet, and they need money.
And they need money sooner rather than later, not to wait till the dust settles, but they need it now. And just to put a point on that, if I read a report that BRAC issued about the Ebola experience in terms of the quality of the portfolio, what you also learned, the lesson that people need money and they need it fast, but also the quality of the portfolio was incredibly strong coming out of the Ebola experience. Could you want to say one more comment about that? Because I think sometimes the worry is from investors, well, wait a minute, yeah, the need is there, but is the performance going to be there? And are we going to be exposing ourselves to big losses?
Yeah, actually, we came out of that way better than we thought we would. I mean, our forecasts when we were locked down during Ebola were really bad. And then when we came out, again, we were surprised by how resilient our clients are. And especially, we've written about this, I keep saying this in every webinar I go to. Poor women, the women that we lend to, are incredibly resilient. They face they face crisis after crisis after crisis. Something like this hits us much harder than it hits them because their lives are a continuous struggle against crisis. So they've got this resilience. They know how to get back on their feet. They know how to get through it. So if they get the right support at the right times, they do recover very quickly. And even with our portfolio in West Africa, as soon as you go out and you start lending and you start showing that money is available, liquidity is available, people want to pay off loans. People want to get fresh loans. People want to start earning. They need working capital. And we're seeing, it's been about 2.5 months since we've begun operations post-COVID, or post-COVID lockdown, I should say. COVID's still there. But we're seeing the same thing. People want to get back on their feet. People want liquidity. They want to pay off their last loans. We're doing a lot of refinancing, and there's a lot of demand for that as well. So very similar experience this time again.
Fantastic. Thanks for sharing that, Shameran. So Nick, I want to turn to you and move into the responses. So we have a sense of where some of the big demand, if you will, and the need, which is only being exacerbated by COVID. You've spoken to the need for better and stronger intermediation. So as you look at the current landscape, Nick, and you referenced a little bit about the directed lending, but can you give an example or two of a transaction that CDC is either brought to market now or in the process of bringing to market that you're ready to talk about, to give us a sense of what you mean and examples that we hopefully can all learn from?
Yeah, so let me talk about, in a general sense, what happens when you have a crisis like COVID is that, and we saw the same in the global financial crisis, what you see happen is every investor around the world, commercial or otherwise, seeks to take risk off. And you take risk off when you're taking risk off, you typically do it by moving away from the things that are furthest away, that you know least well, that you perceive to be highest risk. And so we've clearly seen that happen from the beginning of the COVID crisis, and that's why vast amounts of money have been sucked out of Africa by large financial institutions. And when that happens, the role of the development finance institutions, whether it's the CDC and the other bilateral European DFIs, or whether it's the big multilaterals like the IFC, our role is to sort of be counter-cyclical, to step forward and to sort of try to fill that liquidity gap. And I think both Shameran and Marie talked about the importance of liquidity. But I think when you're thinking about solutions, particularly when you're sitting in a seat like CDC, I mean, you really do need to be thinking about, I think, three things. You need to be thinking about speed, you need to be thinking about scale, and you need to be thinking about simplicity. And I think a lot of the sort of knee-jerk responses that you often see, particularly I have to say from the impact investment community, tends to put a higher emphasis on sort of more complex solutions. And those are, and I'm sure we'll talk about, they are hard to, difficult to do, hard to implement. So I think our focus has tried, as I said, has tried to be on what can we do quickly, what can we do in size to really make a difference, and what can we do that's relatively simple and sort of understandable. So I would, rather than one specific transaction, what we have done the most of is a series of transactions in what we in the trade finance area, and where we have provided funding through banks for effectively unsecured loans to companies. Probably we've done since COVID started 440 million dollars of funding, most of it, the largest part of it, to Africa. Probably about 40% of that finds its way to SMEs. And that really, that trade finance and the supply chain finance that Anne-Marie talked about, that's really the lifeblood that keeps companies going through a crisis like that. And as I say, it helps you to reach, it helps an organization like CDC reach small businesses at scale. It helps us to reach the SME population with at least a significant part of it. It is a relatively low risk product. It has very high impact because it actually, on a very real basis, saves jobs. It allows us to get a much better data. I mean, the loans that are made through our trade and supply chain finance programs are as low as $6. Is the lowest loan we've ever done. So it's a very, you get a huge number of sort of data points around borrowing, and it also allows us to sort of tilt. Because as we do these through risk-sharing partnerships with people like Standard Chartered or ABSA or others, it allows us to tilt the sort of the incentive structure or the risk structure within these products, so that we can we take a higher share of the risk if they're going to tougher countries. So for example, places like Mali and Mauritania take a higher share of the risk when we're going to country where products like medical products, PPE, for example, imports. So that's I think the best example of, as I say, we've done probably now 5 or 6 large programs directed mostly at Africa, total about 440 million dollars. And that, I think, is the best example of how in the SME area, certainly. I mean, obviously you've got other examples in medical guarantees and so on, but in the SME area, I think that's the best example.
I like your 3 S's, the speed, scale, and simplicity. I like alliteration, so I like those 3 S's. And our topic is accelerating. So my 2 follow-up questions, Nick, and I know this is tough, but how do you as CDC get assurance that the money is going to, for SMEs that beyond the existing clients of those banks you're financing, or not? How do you get assurance on that? And to your reference about the $6 loan, how do you find out where the focus is on the S versus the N, just to give you the sense that you know the end destination of your money?
Yeah. So I think, and the question of how you get assurances that money goes beyond the existing client base, I don't think it does. I think you have to be really very realistic about what's possible at a time like this for lending institutions. They are not going to go out and, they are busy, as somebody else said earlier, focusing on how do we protect our existing client base? How do we make sure that they have the liquidity to survive? And so the idea that they will be able to go out and build and massively expand their client base at a time of enormous crisis is unrealistic. So we have to try to make sure as much as possible that our money is spread as widely as possible. And we get one of the advantages of these type of programs, you get very detailed, specific information on the individual loans, who it's going to, what it's for, what country it's in. So you can get from our position, looking from a portfolio base, we can see what the spread is, but it's not because, and obviously, as I said, we have used it to tilt, we have used the incentive structures within the risk sharing structure to try to tilt money towards the toughest countries, towards the critical sectors. But I don't think that we would suggest that it's going to a whole lot of clients that haven't borrowed before or don't have some sort of existing relationship.
Yeah, I think that the clarity, which is what we talked about at the very beginning, is critically important. So I thank you for being so clear about that. And I would just can make one connection as I turn to Anne-Marie for her examples. I think one of the reasons that we sometimes hear that comment, Nick, that you've made about impact investing transactions being complex is, I think, because oftentimes the impact investing transactions are focusing on the segments that are not yet in the financial system. They're not being underwritten by the banks and others. And so there's a perception of complexity because that market segment is less understood. I mean, it's one of the observations, at least I would make in the deals that we've seen. Anne-Marie, could you share from an example or two from your organization, and particularly this notion of money either going to existing SMEs for the reasons Nick has mentioned, which are very much understood, or how are you pushing the envelope to go to new in some of the deals that you're bringing to market, or not?
Okay, no, thank you for that. So we have been looking before COVID-19 at a number of transactions that were through alternative credit providers. So what we did when COVID hit is we rapidly just focused on accelerating those investments because we felt that those intermediaries, because they were new and alternative, were better placed to deploy the capital to the market that we care about, so to the micro and SMEs through themselves alternative intermediaries. So we're hoping, and we've got a board meeting this afternoon, and I hope that we can make an announcement soon, but we have fast-tracked an investment into a vehicle that we hope will provide capital to some of the digital lenders who are serving some of the sort of asset-backed payment or credit providers and SME lenders. But we also, given the nature of our capital, again, going back to Nick's point of speed, scale, and simplicity, we do have to do our due diligence. We can't be reckless in the way we want, even though we want to get capital to the market quickly. And so we had to be smart about that. And being smart is about leveraging and collaborating with other partners. So we are collaborating with CDC on a particular transaction where we can use our risk capital to actually leverage to increase the amount of capital coming into that particular vehicle, because we can take a higher risk, if you will. We have a higher risk appetite. And because we're in the market, we have comfort about the strategy of this particular investment. And so we were able to quickly collaborate on that DD process to fast track it in order to quickly move capital into this market. I mean, it is a challenge. It's reality, and it's important that as investors that we do have strong partners that we can quickly work through to address the risks that we're taking as we try to deploy that capital to the SMEs. I wish I could tell you more about details, but hopefully there'll be an announcement soon.
So we should be watching the FSD Africa Investments website for the announcement. But no, it sounds like it's.
Yeah, but we are pursuing other collaborations with other organizations. And again, here it is about identifying the alternative providers to the private equity, private debt type firms that we're familiar with. That are closer to these early stage businesses. So they need capital as well as these early stage businesses. So that's something that we're actively working on, which we hope, again, before the end of the year, we can make some announcements on.
No, it's fantastic. And it really underscored the importance of that risk appetite capital that you bring to those transactions, Emery, particularly in the context of what Nick has described as an understandable defensive reaction that investors are having to the uncertainty of the marketplace. So that capital is even more catalytic than it was pre-COVID, and it was catalytic then. So a terrific underscore there. Thank you. So Shameran, to you, what can you talk about a response or two that you're actively pursuing in the marketplace, and this notion of accelerating flows to capital, which you did speak to, as well as expanding the universe of folks who are receiving that capital. There's, again, it's not an either or, it's an and. We want both ultimately. But how is BRAC looking at that, and what kinds of things are you working on in the market now?
Yeah, so of course, I agree with the point that, in a situation like this, our first response is to make sure that we are going out, looking at what our current clients are doing and figuring out how to refinance and get them back on. But, we've been very focused on and continuing to grow in both the microfinance space and the small enterprise space. So we, a couple of years ago, we sort of developed a new strategy, which is a sort of a growth and impact strategy for our work in sub-Saharan Africa. And even through the COVID period, we've always been focused on, okay, so we might take a short-term pause, but how quickly can we get back onto that growth and impact plan and really start building our work? So I'll just say that, look, this small enterprise segment that we work with, as you said, I mean, they're not typically bankable because they're informal, right? They're quite informal. And so banks don't venture down far enough to lend to these entrepreneurs. And for typical microfinance lenders, they're not your typical group clients. You can't do joint liability. You can't do any of that. They've got to be dealt with individually. So these are informal individual clients. You do see higher default rates than your typical microfinance lending segments. But the number of people, the number of entrepreneurs in almost any country where we work, where you could lend anywhere between, let's say, as low as $2,000-$3,000 to, let's say, $20,000-$25,000, the number of people in that space who are just too big for MFIs and just a bit too small for banks is huge, is an amazing opportunity. And if we as organizations can learn to lend to these entrepreneurs, there's a huge opportunity there. There's a massive amount of demand for credit, and we've got to focus on that. So we continue to grow our microfinance work. We continue to grow our SEP work. We are back out in the market. We're looking for liquidity into all of our microfinance entities in Africa and Asia. And we've actually weathered this COVID period quite well by doing some of the things that, again, we learned in past crises, like Ebola, keeping close contact with our clients, going back out, lending to them as soon as the lockdowns went away, doing refinancing. And we feel that starting now, actually, almost, we can actually go out, not only refinancing and lending to our current clients, but actually growing our client numbers. And another point I'll quickly make is, even in the post Ebola period, we got some concessionary funding to go out and lend to petty traders in Sierra Leone. And we did that very successfully. So if there's funding available, organizations like ours can actually go out and get to new segments very quickly because we've already got the distribution in the countries where we work. So,
well, that's an invitation. That's a terrific point, and an invitation back to Nick and Anne-Marie. And it's resonating, Shameran, with the questions we're getting in the chat window. So people are saying, yes, you follow the conversation, understand the points being made, but the gap, the S of SME, huge market, as Shameran is just reinforcing as an operator, and they're just not being attended to. And when the folks who step up to attend to them, they might be a first-time fund manager or a non-bank finance company, and they struggle to get funding. So the question back to Nick and Anne-Marie, from your vantage point, what can your organizations do or not do to actually help those intermediaries who are actually positioning themselves to reach that S of SME to accelerate the flows of capital? Any thoughts Nick, maybe you first and then Anne-Marie, or the other way around, doesn't matter.
Well, I think, I mean, as always, the devil's in the detail in these, the devil's in the, as always, the devil's in the detail in these discussions is when we talk about sort of small or micro, what we're actually talking about. I mean, Shameran made a critical point about formal versus informal organizations. You know, if you don't have a corporate form, you can't invest equity in a business like that. It is very difficult for many banks from just a risk and regulatory perspective to invest in organizations without a corporate form. So I mean that's I think a critical distinction. From I look at I mean if we're talking about really the smallest loans, so we're talking about a few $1,000s to informal organizations on an unsecured basis, on a sort of with no sort of personal guarantees or assets guarantees or anything like that, then I think we are relying on the organizations like BRAC who are developing out of their sort of group lending microfinance model to because that's what they do. Our job's to provide, as we have done and continue to do, to organizations like BRAC, liquidity and funding so they can do more of that. But again, we have to be realistic about what's possible here.
No, I completely agree. The realism, absolutely right. Anne-Marie said the due diligence, but I think that clarity of segmentation does help to be able to address some of those concerns, as Shameran was framing it. Anne-Marie, I want to make sure we do one final round of a call to action from each of you. So we've got 2 minutes. So you've got 30 seconds to say anything you want to say about
call to action at the same time. So we are, there was a question about early stage fund managers. And what we need more of is we need more data about these early stage fund managers, these alternative fund managers, local capital providers, whatever you want to call them, that are actually transacting these very, very small amounts of money from $50,000 to maybe $500,000. We have begun to put together a database of these alternative capital providers. And I'm very pleased to say that the majority are women-led. And there could be one person, an investment professional that's really seeing this opportunity in the market. And so I think what we need more of is we need more data, because I really believe that this issue of how do we invest in first-time managers is something that we just have to put aside and jump in and support them, because they're very close to these micro or these small businesses, early stage businesses. So more data.
Love that. I love that. And jumping in and supporting. Nick, your call to action, and then Shameran, you'll close us out.
Just a quick response to what Anne-Marie said on first-time fund managers, because obviously CDC has been supporting first-time fund managers for ever since that certainly the private equity market started, with, I must say, very variable degrees of success. I think the one thing I would say that we need to learn from is that simply importing a developed market sort of private equity limited partnership expensive model does not produce sustainable managers. And so we need to be, again, realistic about that, that we need much more innovation around things like permanent capital structures, and also sort of low cost, more mechanistic intermediation, which I think particularly for loans are much more difficult for equity. So that's just on the first-time fund managers. Sort of a call to action. I mean, I think you position this, Laurie, as a call to action for the impact investment community globally, and this is what this conference is about, the global impact investment community. My call to action is that it's time they started getting, the community started getting serious about focusing on Africa. We spend all our time talking about the growth of impact investment. We talk about the importance of achieving the SDGs. And the reality is that when you look at Africa over the last 5 years, the amount of capital going into Africa is not increasing, it's declining. That's the reality. So,
Yep.
and yet you go to the impact investment conferences and you get all these people and they're putting up pictures of smiling African faces and so on. The impact investment community is almost invisible in Africa. So I think my call is that let's get serious about addressing some of these issues. You're going to have to show more flexibility around things across this sort of continuum of capital and returns. You're going to have to focus more on catalytic capital. We have a program called, Catalyst, which tries to look at investments in areas that are higher risk and enhanced impact. So I think that's that would be my, again, I suspect the people on this call are interested in Africa anyway, but as a, from the point of view of the whole conference, I think it's time where people really did get serious about addressing SDGs in Africa.
That's a great point, Nick. Thank you. Shameran, your call to action?
Yeah, quick call to action, provide liquidity. I mean, that's my call to action for both the financial institutions lending to the SMEs and also to the finance, whether it's development finance institutions, impact investors, provide liquidity to the institutions that provide money to these SMEs. Just
super.
More liquidity.
Super, because we've got operators like Brack who can do it. Thank you. That's great. And I'm gonna close with a parallel to Nick's alliteration. 3 C's. Be committed in the capital you're making available in Africa. Be creative and be catalytic. And I think that creativity point, Nick, Anne Marie, Shameran, you all gave examples of creativity, but we've got to bring it and we have to deliver on that. And the time is now. It is an urgent conversation. I want to thank all of you. Terrific conversation. We could have continued this,
Thanks, Laurie.
but hopefully it'll stimulate other discussions in the course of the day.